Coming up in today's show, stocks finished the day mixed, a look at seasonality, how earnings season is tracking, IMF upgrades the global economy, an update on the Middle East and how it's affecting oil, and a look at the market's reaction to Microsoft and Alphabet earnings. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. Hope you're all doing well out there. My name's Jared. I'm going to get you all up to date with everything that's happening on Wall Street and across financial markets that is having an effect on your portfolios as we make our way through Q4 earnings season. With two of the biggest companies in the market, Microsoft and Alphabet, just reported earnings as I speak. We'll dive into those charts in a bit. Just looking across the market today, we got some upgrades across the bank. They ripped up higher today, and we've still got a strong bid in the energy market with oil and gas stocks moving higher again, and it was actually tech the weakest today, led down by semiconductors. S&P 500 did manage to find new all-time highs again today at 49.31 just. We are starting to look a little technically exhausted here on the daily and on the weekly chart as well. And so just looking at some seasonality patterns in the market, we did have that negative Santa Claus rally, the negative first 5 days. Tomorrow's the last day of January trading. So far, we're up a bit over 3% for the S&P 500. So it looks like we're not going to get that bearish trifecta, which is normally a bad omen for the market. And just looking at election year seasonality, so far we seem to be tracking it, even doing a bit better. Started a little soft, however, we're rising here to finish out the month of January. Then looking back at all election years since 1950, typically we peak out in that first, second week of February, and then kind of roll over into mid-March. Then it's pretty much up until the right for the rest of the year. And just looking at the best performing industries year to date, one of my favorites, uranium, coming out on top, up 13%. Then we've got some others like tech hardware makers, of course the semis, coal, oil and gas refining, shipping, and a few insurance industries as financials continue to rip. Looking at the weakest industries year to date, getting sold off really hard, something I'm going to look at this week, clean energy and solar, silver, auto manufacturers, gold, and a few other mining groups. Let's look at the monthly chart on the S&P 500, having a clean breakout to all-time highs this January. Same with the Nasdaq Qs. However, looking at the Magnificent 6, it's no longer the Magnificent 7 now. I've dropped out Tesla of this composite chart we track, as it is diverging a lot from the rest of the group. It's a much smaller market cap than the rest of the group. And so looking at these 6 large tech companies, Microsoft, Apple, Alphabet, Amazon, NVDA, and Meta, ripping out of the gate this year, up over 13% month to date, on top of their stellar performance last year, in which they recovered all those losses from 22, and that's for good reason. The market has foreseen their earnings growth, and they are different from the rest of the market. Looking at the Magnificent 6, these companies are expected to report year over year earnings growth of a huge 53.7% for the fourth quarter. Excluding these 6 companies, the blended earnings decline for the remaining 494 companies in the S&P would be negative 10.5%. And so look at that stark difference in the earnings growth of those 6 large cap tech stocks versus the remainder of the S&P 500. With Meta and NVIDIA, Microsoft leading the way, difference gets even more stark looking at the 4 companies, Amazon, Alphabet, Meta, and NVIDIA. Huge 79.7% year-over-year earnings growth is expected for Q1 2024. In other words, they are on fire. The boom in AI spending is real, and they are grabbing the lion's share. On top of that, we've got an improving macro backdrop with the International Monetary Fund, IMF, upgrading their outlook for the global economy, saying the clouds are beginning to part, the global economy begins the final descent towards a soft landing, with inflation declining steadily and growth holding up. They did say the pace of expansion remains slow and turbulence may lie ahead. Their baseline forecast for growth this year across the world is 3.1%, and that's an upward revision of 0.2% that they gave from October. They did mention rapid improvement in artificial intelligence could boost investment and spur rapid productivity growth, although with significant challenges for workers, which we're already seeing. A lot of mass layoffs happening in the tech sector and others as well, as these big companies look to replace workers with machines. And it's not NVIDIA, the best performing AI stock over the last year. It's actually Supermicro Computer. It's been a stock market leader for a couple of years now, up a massive 585% over the last 12 months. That's on the back of their latest earnings result, which they blew estimates out of the water, with the CEO saying, while we continue to win new partners, our current end customers continue to demand more of Supermicro's optimized AI computer platforms and rack-scale total IT solutions. There's a look at the daily chart of SMCI, which is already up a huge 82% year to date. So the momentum and rip in tech, semis, anything to do with AI is still well and truly alive. And we've just got earnings from Microsoft and Alphabet after market close as I speak. We had Microsoft earnings beat as cloud grows 30%. It's amazing the growth rates. Some of the biggest companies in the world are continuing to achieve. For their fiscal third quarter ended December 31, company reported revenue $62 billion, about $1 billion ahead of street estimates, with profits coming in at $2.93 a share, once again well ahead of what the street forecast at $2.76. They reported better than expected revenue in all three of its business segments, with Azure and cloud continuing to grow at really good rates. And Microsoft CEO Satya Nadella has done an excellent job since he's come on board, and he's infusing AI across every layer of their business, really diving headfirst into the theme, and even their legacy product of Office continues to grow 13%, which is very impressive as well. Moving on to Alphabet, the owner of Google and YouTube, they reported revenue of $86.3 billion, up 13% from a year ago, beating expectations by a little bit. Same with EPS, $1.64 versus $1.59 expected. They did come in a touch soft for their search advertising, still the bulk of their business, a little bit lower than expected. And like I said, this is at a time when they're doing big layoffs. So they're managing to grow their profits while firing a lot of people, and that's music to the ears of Wall Street. Let's look at the daily chart of Microsoft, and just taking you down to a 5-minute chart after hours. Got a bit of volatility here. Currently off a touch, 1.3%. Let's look at the daily on Alphabet and the 5-minute chart after hours. That doesn't look good at all. Being sold off 4.6%. And just looking at the Qs after hours, they're selling off steadily as I speak as well, down 0.6%. And so just looking at the composite chart of the Magnificent Six here, looks like we could have had a bit of a buy the rumor, sell the news. We are up 14% year to date across the group. So this could be just a little bit of healthy profit taking. Based on technicals, sentiment, and liquidity, markets had a great rip, and looks like those big numbers needed to come in to justify that rip, and now we're just seeing a little bit of profit taking on the group after hours as I speak. So Microsoft's now the biggest stock in the market. We'll get to hear from the second biggest stock and previous leader for a long time, Apple. They're reporting earnings after the close on Thursday, and they've been the slowest growing company of late out of the Magnificent Six. And some are saying their shipments of the new iPhone may drop by up to 15% because of multiple issues, including the iPhone 16 not being a compelling upgrade, something they've been criticized of for a few years now. Each new model isn't really that different from the previous one, maybe overdoing it in their upgrade cycle. And looking underneath the surface, we're already seeing it's lowered its shipments of key semiconductor components. However, investors continue just to love Apple. Could be the Buffett factor as well, with Apple representing almost 50% of Berkshire Hathaway's stock portfolio. And what's interesting with Apple is in the last year, they actually saw their revenue decrease to $383 billion from $394 billion in 2022. And looking at their revenue growth from 2018, it was $265 billion to now $383 billion. That's about a 44% increase over the last 5 years. However, looking at the monthly stock price of Apple in that time, over the last 5 years, stock's up a whopping 356%, even though revenue's only up 44%. Let's look at the daily chart of Apple, actually the weakest of the Magnificent Six today, down 1.9%. And so by the looks of it, they may come in at expectations or maybe a soft beat or soft miss. It'll just be interesting to see the market's reaction and whether this year could continue to hold up with the rest of its large tech peers, because it doesn't really have a blockbuster AI product yet. And like I just showed you, it hasn't been hitting those huge growth rates like Microsoft, Alphabet, NVDA, and Meta have been doing. No doubt it's a huge, strong brand, definitely deserves a premium over any other company growing at a similar rate. However, how much further of a premium can it get? Like we've seen in the last 5 years, stock's up 356%. Revenue's only up 44%. And at a market cap just under $3 trillion, anyone that's buying here and is looking to get a double from the stock, we have to be looking at a market cap of $6 trillion, which seems really huge. Anyway, come back to the channel on Thursday afternoon and we'll dive into their earnings and see what's going on there. And not everyone's so keen on these magnificent stocks. Got a $2 trillion asset manager forecasting them to actually underperform this year. That's Amundi, one of the largest asset managers in the world. Still expects a mild recession and that the market's top performers will fall back to earth. They said they're underweight US stocks for 2024, and the stock market today is far different from a year ago, with them also saying the US is very expensive relative to itself and to the world, and saying that bonds look attractive and appear to have limited downside and they could be poised to benefit from a Fed pivot and easing inflation. We've got some quants at JP Morgan saying today's big tech dominated stock market has shades of the dot-com bubble, with them pointing to the persistently rising concentration in the US stock market becoming an important risk that investors should be aware of. And it's true, there are some parallels between now and the late 90s in tech in terms of concentration and performances. However, one big difference is is these big tech stocks have the earnings to somewhat back it up a little bit. Because back in the late 90s, they didn't really have those huge cash flows that they have now. However, for them to maintain these huge concentrations in the indices and their stellar stock price performances, they have to keep delivering these 20-30% growth rates going forward, because as soon as they start to flatline, then they could drop like a rock. Moving on, we've got the Fed kicking off their two-day meeting, the first of this year, to decide what interest rate should be. It's pretty much a given they're going to remain on hold. We'll get the Fed press conference tomorrow. We'll just be looking forward to language out of Jay Powell. Mark's going to be looking for hints at when he's planning on doing his first rate cut this year. And we may hear him push back on a rate cut in March. Given how well the economy is holding up, retail sales beating, unemployment low, got some moves up in the price of shipping rates, oil, not to mention the drop in yields over the last couple of months. Could be adding a little upside pressure to inflation as well. We also just had consumer confidence come in at its highest level since December 21, so consumers are out there feeling good. Nothing's really breaking in the economy just yet, so I don't think they need to cut rates right now. And Fed Fund futures starting to think the same thing. Seen a big flip over the last couple of weeks. Previously pricing in almost 80% chance they're going to cut in March. Now it's getting lower by the day, currently at 40% chance. However, the market's still giving very heavy 84% chance they will cut in May. So we'd have to really see some hot CPI prints for this to get pushed back further and further. And for those hot CPI prints to come in, we'd need to see a material move up. One of the biggest drivers of inflation, the price of oil. And just like we've all heard over the weekend, unfortunate attack once again by Iran-backed militants on a US military base in Jordan. And like I've been saying for a while now, we can expect more and more of this stuff as Iran keeps poking and poking away at the West and all of US bases over there, of which there are a few. And so since the Israel-Gaza war began back in early October, it's been going on for a little over 3 months now. It's been 165 attacks on US troops, and unfortunately over the weekend one of those drones got through in a bit of a mix-up. And so Iran continued to F around. They're going to find out from the States pretty soon. And another sign of continued escalation more and more over there. Seems like we could be approaching a boiling point where things could really spill over in a direct conflict between the US-led Western Alliance and Iran itself, instead of their backed militant groups all over the place. And so apparently Biden's just given the go-ahead on the US's response to this attack, which killed 3 US troops and injured a couple of dozen others. And we may see a response directly on Iran assets in addition to the militant groups. And so how does this relate to markets? Well, it should keep a bid in the price of oil. Still got half the world's supply coming out of the Middle East. They are the biggest swing factor in the price of oil. Got steady supply coming from the States. Also got Ukraine-linked drone attacks on Russian energy infrastructure as well, who are one of the biggest producers of crude in the world. And so we're just getting more and more flare-ups over there. And so it's no surprise we've got the price of crude kind of holding ground here, just below $78 a barrel. We almost got up to $80 yesterday. And unless things really cool down over there, the price should stay bid above the mid-70s. We may even start to see $80 or more over the coming weeks. And that's going to keep the upside pressure on inflation. Also just got a contract rollover in the gold futures market. It's trading above $2,050 an ounce. And that's another sign traders are looking for a bit of a safe haven here with what's going on over there. And just looking at the sector of aerospace and defense stocks, ETF ITA, that's hovering just below all-time highs as well. And with one of my top 10 picks for this year, cybersecurity stocks doing a pretty good job out of the gate so far, up over 7%. And so Western enemies could be stepping up their activity going into the most important event this year, the US federal election, and what's looking like to be another showdown between Trump and Biden. And just looking at the VIX futures curve, up until September, looks like a normal state of contango, where the further out you go, the higher it is, because the higher probability will have a fixed spike before then, so it's kind of always priced in. However, looking at that jump in October, which is a month before the election in November, because VIX is priced off 30-day options, and so there's a huge and material spike that the market is forecasting for November, so we could see a bit of fireworks in the markets in late October going into early November, especially if we see Iran continue to ramp things up. Then the US-led Western Alliance has to give a material response to kind of deter them from their continued attacks on US bases, not to mention our shipping and cargo ships going through the Red Sea as well. And we may just need to reach that boiling point for it to be resolved. But for now, looking at the VIX index, things are pretty chill. Still at 13.3. There's a look at the weekly chart. It's been on a steady decline since late 2022. However, later on this year, going into November, we shouldn't be surprised to see a potential spike up back above 25, or something else might take us there. We always get in a surprise, and so it's highly unlikely that the VIX remains this low going into Q4 and the election. Something I'm going to get a bit more into this week is clean energy and all the industries related to it and how they've been hit hard this last couple of years. We've seen a bit of a slowdown in demand, high interest rates which affect these big ticket purchases, some federal tax credits subside and expire, and one industry that's been hit hard is that of electric vehicles. As a group, they have tanked a lot over the last year or two. There's a look at the cars ETF on my clean energy ETF list here, and this fund has 70 stocks related to the EV industry. And we can see since it peaked in November 21, down a huge 62% in that time. However, that's not the worst performing industry in the clean energy sector. Stick with Click Capital this week and I'll show you some of the others and some of my reasons why I think some of them are starting to look a bit cheap and could make for good long-term investments at these levels. Bucking that trend is one of my cheap old economy favorites for a little while now. A lot of you guys know I've been talking about how undervalued General Motors has been these last couple of months. We just saw them come out with really good earnings. Quarterly revenue, a huge $4 billion above consensus, along with net income, $1.59 a share for the quarter, up from $1.39 a year earlier, well ahead of the $1.16 consensus. And so they're still in the midst of a massive EV transformation. Like much of the industry, it's been hurting their profits as they can't make money on EVs yet. Still going to be a few years away before they get really profitable on EVs to build out the infrastructure. You know, they've been selling internal combustion engines for 100 years. They can't just flip the switch to EVs overnight. This is a long-term process, maybe a decade or longer. However, they're still generating a lot of cash from their traditional businesses. That's why they're able to do $10 billion share buyback program. And we can see that in the stock price today. Almost up a huge 8% and well off these lows back in November, now up 45%. Still only a $52 billion market cap. And we'll get to hear from Ford this time next week as well. They haven't had quite the bounce that GM has had these last couple of months. Moving on to economic data today, we've got some GDP numbers out of the Eurozone starting to look a little bit better, with France beating year over year. Same with Spain. Germany's still the weakest of the bunch, and Italy also beating. Overall for the group, only up slightly year over year. And just looking at the states, home prices up 5.4% year over year. Job openings coming in better than expected, and consumer confidence a little less than expected, but still well up on the prior month. Fear and greed index still elevated at 74, and not much action from corporate insiders. Looking at breadth today, we've got a healthy 573 stocks and ETFs breaking out to 52-week highs, led by big tech, and financials doing well too. JP Morgan, Visa, Berkshire, MasterCard all showing up there today, and a very thin 66 securities breaking out to 52-week lows. Nothing really of note, just a bunch of China stocks, along with some clean energy stuff as well. As a look at the 2-year government yield going into the Fed meeting, holding ground here above 4.3%, and a little bit of a pullback in the 10-year, still holding above 4%, which has given a bit of a bounce back in TLT, and the dollar just tracking sideways above 103, with Bitcoin reclaiming its 50-day VWAP above 43,000. Same with Ethereum. A lot of people wondering whether we're going to get some Ethereum ETFs now. As a look at China securities, still really volatile, having a pullback today, along with clean energy. Still trying to find a bottom down here. A little mixed across international stock indices. Looking at sectors today, ARK and IPO stocks were the weakest, with the leader being oil and gas. And just the latest look at Microsoft as I speak, still down 1.7% after hours. And Alphabet doing a lot worse, now down almost 6%. There's a 5-minute chart, really not looking too good there. It's going back to the daily. Like I said, the market kind of just front run this result. It's now doing a bit of profit taking, but still that's a pretty big sell-off. We're currently around here on Alphabet as I speak, 142. So that could spook the market tomorrow if this level holds. So look at Tesla, also selling off a bit after hours, still a bit technically oversold here. Just got earnings on AMD as well. Looks like they came in line with expectations. There's a look after hours, down 5%. And this stock's ripped more than most of the rest of them, going from mid-90s back in late October, almost doubling over the last couple of months. Meme stocks were down across the board, and we got an upgrade on the financials today. That's why we've seen the big guys like Bank of America, Citigroup, and JP Morgan put in some really nice green candles today. This group continues to remain strong, along with industrials and home builders. And just looking at my sector trends table, we now actually got the Qs, tech, and semis having a bit of a short-term pullback. Weakest industries, clean energy, REITs and biotech, still not really strong either. But we got the home builders, financials, industrials, healthcare, and now energy, oil and gas back into uptrends. And there's the S&P 500 coiling up, really low range day today, just 15 points. Markets Obviously waiting to hear from Jay Powell tomorrow. Maybe that gets things moving. Did got the VIX one-day index popping up there. Maybe pricing in a bit of volatility tomorrow. Volatility risk premium still a little elevated. But what we'll really be watching tomorrow is how these Magnificent Six react after these earnings from Microsoft, Alphabet, and AMD. As a group, they're down 2% after hours, with Alphabet the weakest. So we'll see whether those gaps down tomorrow morning get bought and they hold, or do we melt away, because this could be a good point for a bit of a pullback and correction in the market. Like I said on Friday, we had 20% rip up from October to January. Then we had another 20% rip from those March lows up into those July highs. And then so currently we're almost at a 20% rip here, just about the same. And if we were to get that 50-60% retracement of this move, that would take us to around 4,500, 4,450 on the S&P 500. Then the big one will be Apple on Thursday, and what their numbers are and how the market reacts. As like I just showed you, these are the biggest drivers of the market doing all the heavy lifting. The rest of the S&P 500 earnings are still actually declining, and so we really need mega cap tech to hold up here to hold the markets up. That's all I got for you today. Thanks for tuning in to the Daily Show and hitting that like button, and I'll see you again tomorrow night. Cheers.